I think the key event has obviously been what the events in the Ukraine and the Russian integration of Crimea back into Russia. Whilst I think it has not really moved markets, particularly at this moment in time, I think it has the potential over the next couple of years to remain a sort of festering sore in the relationship between Russia, the United States and Europe. We don't currently expect an escalation to something that we might describe as war, but it will clearly raise political tensions and therefore probably underpin energy prices. But when one looks at the global equity markets, I think the interesting moves have been the weakness in China and Japan. Both are facing different challenges. China is trying to rebalance its growth. Japan is trying to reignite growth. Both policies are clearly fraught with tension from an international investor's perspective, and therefore we see different opportunities for both those markets. In Europe, peripherals have done very, very well. International investors have loved to come back to peripheral Europe, probably because of the hunt for income, and we're seeing that at the expense in Europe of the market performance of the UK and of Germany. So the core versus the periphery is still a trade both in credit and equity markets. In general, though, I would typify global equity markets as steady as they go, pretty resilient, because what we really have seen is a churning of the market levels, a lot of movement underneath at the sector and the stock level. But of course, we're coming off two exceptional years of 2012 and 2013 for equity markets. And so I think a period of stability is actually what's required to keep investors' confidence high rather than seeing us rally and then fall back and undermining that confidence. So steady as we go, the markets, particularly in Europe, still look very attractive. Dividend yields are high. And so we think the prospects for the second half of the year remain constructive. Clearly, the central banks are very important to the prospect for the markets in the rest of this year. And really, it's a tale of the three large central banks. The Bank of Japan remains very much disposed to supporting the Prime Minister Abe and his economic policy. But I think what we're seeing at the moment is a postponement of more quantitative easing whilst the Japanese take a view or take a sounding on how the other policies that have been implemented are actually affecting the underlying economic prognosis. The US is still in tapering mode. We would anticipate at every Federal Reserve meeting that a bit more tapering will occur. That would mean at the moment that they are still printing about $50 billion a month, down from 85. So it's not that they're not printing anymore, they're just printing substantially less. And obviously I think in Europe there are rising fears of deflation or disinflation, and therefore correspondingly rising expectations of quantitative easing. We don't believe that the ECB will quantitatively ease as the way we've seen in, say, the UK or the US. But we do think the ECB has plans in the second half of this year to maybe stimulate the lending markets by trying to disintermediate the banks and creating an asset-backed securities market that allows them to get credit to the corporates in Europe who badly need to be able to access credit, to invest, to hire and to grow their products. So we think that's the tale of much of 2014. Generally, the policies will remain broadly as they have been, and we wouldn't anticipate much change. Corporate earnings, I think, are now going to be an increasing focus of equity investors. What we've seen with the rally in 2012 and 2013 is effectively a re-rating of equities without any underlying earnings growth, both in the US and in Europe. So what we really need to see is that the policies of the central bankers and the politicians are leading through to a growing economy and a growing earnings pool for companies. Now, expectations for 2014 came in Europe for something like 10 to 12% earnings growth. We've had a solid, but I would say dull, earnings result season so far, and expectations have fallen to about 8. So I think as we look into the second half of the year, both for the US and the UK and Europe, we need to see growing investor confidence and growing corporate confidence in earnings growth so that the market can then grow into the re-rating that we've seen in the last couple of years. What we've recently seen, particularly in the pharmaceutical, the healthcare and the technology sectors, has been quite an aggressive level of mergers and acquisition activity. This is also to be juxtaposed to a lot of issuance that we've seen, particularly in technology in the US and to some extent here in the UK markets. So I think investors have been anticipating that much of the corporate cash would basically put to one of two uses. They would either get it back as share buybacks or dividends, or the managements would spend it. So I think what we're beginning to see is many companies and their managements feeling sufficiently confident to start to put that money to work. But I would suggest that many investors need to think about some of this M&A in two ways. Some of it is clearly constructively, strategically important to the company, and therefore will build on a longer-term earnings base that shareholders should therefore profit from. But quite a lot of it, and some of it is definitely driven in the US by tax concerns. Basically, the tax they hold offshore is untaxed in the US. They don't wish to repatriate it, and therefore they're going to spend it, and they're going to try and lower their corporate tax result for the whole new entity as a result. I think this is more like tax avoidance or evasion than it is strategically important, and as such, this type of financial engineering worries me because it means that they're not doing the deal because it's good for the company's strategy. They're doing it because they think it's good financially. I hope we can differentiate between the two in the portfolios we manage. I believe that politics in the rest of 2014 will play an increasing role in giving investors a sense of the journey that many economies will be on. Clearly, in May, we have the important European elections. I think this is less relevant in terms of changing European policy towards austerity and the restructuring that is going on inside Europe, but it's important in assessing the credibility and the robustness of the national governments. So if we see a big protest vote or a big swing against the incumbent governments, we will then possibly see a response in the next couple of years in terms of their policy. However, we've talked a lot in Europe about politics and whether it's good or whether it's bad. I think politics is now very, very important in other parts of the world. Following the tapering comments of 2013, we've seen a lot of political disarray in Thailand, in India, in South Africa and Brazil, amongst others. And we now have those countries coming up for elections. What is important inside the emerging markets is that the new governments continue to foster the ability of those economies to restructure and to compete globally. If we end up with status quo or ineffective governments, then some of the attractive emerging markets will remain simply a myth of opportunity. India is particularly the case in point. The new main chance, Modi, looks like he offers a very strong restructuring story, but if he doesn't get the mandate to change, then clearly it will be a lost opportunity for the next 2 or 3 years from an Indian perspective. So I do think politics is worth watching. I think the US is not on the agenda at this moment in time. The UK will come in 2015 with its general election. But I think really it's the emerging markets where we will see political tension and political opportunity most at risk or most to the advantage of investors in the rest of this year. I think the rest of 2014 is going to pretty much reprise the first 4 months of the year. We see equities, I think, returning a reasonably positive income to clients, and certainly outperforming bonds and credit, which are barely keeping the purchasing power after inflation in their local markets. So I think as we look forward, we would continue to see equities as a better place to be. You have to take some risk during a period of financial repression. And we think the theme of financial repression really plays to two themes. It plays to structural growth, either through the companies themselves or through the mid and small caps as an area, and through dividend yield as the hunt for income remains very apparent for many clients. So within that, and looking around the world in the global equity space, we very much see Europe as more attractive than most of the other major markets, despite the political concerns that we will have in May. And I think we would, inside that, continue to invest clients to look at how they're going to defend themselves against the levels of inflation or return expectation that they and their clients have. I would point out in Europe that food inflation is very high, healthcare and education are very high inflation rates. So whilst our cost of living may not be reflected in government statistics, many of our clients and their purchasing power actually need a reasonable return, which at the moment, generally equities is the only thing able to deliver on.